we like to measure the price to earnings ratio of stocks. And if we look at the market itself and say what's the overall price to earnings ratio of the market, there's several different ways that you can measure that price to earnings ratio. You can use the Shiller PE ratio, you can use the CAPE ratio, you can use the Tobin's Q ratio, you can use the S&P 500 from its regression. You can go back and look at a long-term mean and then determine, okay, where's the market at relative to its long-term mean? Are we overvalued or are we undervalued? And as we talk today, we're more overvalued if we take a combination, an average of those four measurements. We're more overvalued today from a whole market perspective than we were January 1st, 2000, just before the dot-com bubble burst. Does that bother you, and what are you seeing as far as risk in the markets today?
So lots to unpack there. And I'll just add on, because you kept saying we, and I don't know if this was intentional, but we as in the U.S. stock market on a global scale is the most overvalued market in the world by much of those measures. And of course, we all, as investors, we have a home country bias because we want to own companies that we know and understand, that we see day to day in our lives. And so there's a whole other level of that, which might mean now why we need to take a more global, a global approach to finding great companies that are going to be beneficiaries of some of these themes. But I digress. So I'll answer it. I don't mean to sound like a politician, but you asked me if it worries me, and I think the answer is both yes and no. It worries me on the short term. It worries me in that when I look at a lot of these, a lot of those metrics you mentioned, the question we keep asking at AllianceBernstein, and I go back to this, is to what extent have we already been paid the future return of a lot of these companies? And in many cases, it's a lot of it. Like you said, these companies would have to have unforeseen growth. I mean, growth better than some of the companies that were literally built, poised to benefit from a year like COVID would have to continuously see in the future. And most likely that's not going to happen. Now, what's different this time is, again, it's always relative to what. And when I look at how overpriced the bond market is in many ways by similar sort of metrics, bonds are also expensive. So so there's an acronym, Dean, that we use, and I'm probably sure you've heard it. It's TINA, T-I-N-A. There is no alternative. And TINA's at the party, meaning that to earn any return for an investor that owns a classic 60-40 balanced portfolio, to try to get to that long-term average return of 5 or 6% is going to be a challenge, because those bonds, because interest rates are so low, aren't going to give you the return they did over the past, not just 40 years, but even 5 or 10 years.
Right.
And like you said, a good chunk, a good portion of the equity market is probably trading at valuations that don't allow for a lot of double-digit returns going forward. So this kind of gets into the portfolio construction conversation, Dean. So it makes me nervous because I think investors are going to have to reset their expectations that the returns that they've had over the last 5, 10, 15, 30 years are not going to be the same going forward, and to try to even come close to those former returns, you're going to have to get much more creative and selective in what you do.
So in other words, active management really should come back into vogue with the scenario that you just unpacked.
I don't know how it doesn't, Dean. I mean, I know how it doesn't sort of intellectually, but look, and if COVID was, again, sort of an example of what we're likely to see going forward, again, as far as accelerating some of these trends, last year was a great year for stock pickers. Like you said, I look at our kind of our best ideas fund that can go anywhere, owns only 50 stocks in the world compared to over 3,000, which the equivalent index or exchange traded fund ETF would, and it was up 40% versus its index that was up barely just over 10%. I mean, that's I'm not saying that's going to be the type of outperformance that we should expect year in and year out, but that trajectory is probably something that should sustain itself.
Don't forget to like, share, and subscribe if you haven't already done so. And feel free to give us some comments below. If you want to watch this entire episode, you can find the link here on the screen or in the description below. Thanks for watching.
Starting your route to retirement.